Good evening, everyone. This is Dante. Please remember that futures and options trading is extremely risky and may not be a suitable investment for all types of trading. Please remember that as you watch this video. So here we are, the Sunday evening before the Fed meeting on Wednesday. This is probably going to be the biggest Fed meeting in at least a year. I would say probably since Jay Powell's first Fed meeting back in March 2018. So this will be closely watched, and we can expect some serious volatility as we head into that meeting on Wednesday. Just as a reminder, the press release from the Federal Reserve setting its interest rate policy and its dot plot, which is its projection for future interest rate changes, will come out at, I believe, 2 p.m. Eastern Time on Wednesday, June 19th. Chairman Powell will be giving a press release, or rather press conference, where he'll be talking probably at least half an hour after the Federal Reserve press release, and this will be a period of high volatility depending on what Chairman Powell says. So just be aware that if you're carrying any open positions, and I'm going to mark that date on the chart right here in the S&P futures, it's this one. So we're 2 candles away from it. So I would definitely keep an eye on your positioning heading into that event. I personally do not like to carry positions into Federal Reserve events unless they're defined risk positions such as spreads. I don't want to carry anything that can get stopped out on a hard move, because you can get some really volatile swings on the day of these Federal Reserve meetings. And the reason for that is you have all these computer systems from the primary dealers in the market. The Federal Reserve has 24 investment banks that they use as primary dealers to carry out their interest rate policy. The Federal Reserve sets interest rates by buying and selling treasury bonds through what's called reverse repos, and they use these 24 dealer banks, and during the Fed event, these primary dealers tend to pull back and their computers take over. Market makers for your broker might pull back for about 10 minutes during the Fed event. That's what causes those huge spikes in volatility and those widening of the bid-ask spreads in the options market. So that's not a fun place to be if you have a hard stop. So watch out for that. I will be holding my crude oil position and my treasury bond spreads and my SPX index call credit spreads, because the strike for those is all the way up here. Those expire in about 5 weeks. That position has a huge margin of safety. It's one of my favorite positions to open ahead of these events during these kinds of conditions. So, and that'll be it for me. I'm just going to wait for this Federal Reserve volatility to shake out. The market's very strongly positioned in favor of a rate cut this summer and 2 more interest rates cuts at the end of the year for a total of 3. Now, this, if you ask me, would be very unusual. They're calling them insurance cuts, which is kind of ridiculous. These names the media gives these types of events, but they're calling it an insurance interest rate cut. That the Federal Reserve would just cut rates before the bad data comes out because of all this uncertainty and the bad market sentiment. And the Federal Reserve just doesn't do that. I mean, they haven't done that since, and I can actually pull up the dates, and they haven't done that since 1987. I believe they did that in 1995, and they did that in 1998, my first year of trading. Unbelievable. But in 1998, they did that when long-term capital management collapsed. I mean, anyone who was trading back then will remember that one. That was a huge event. The economic data was good, but East Asian countries were defaulting on their debts. You had a currency crisis, and huge hedge funds were collapsing, and pensions were at risk. So the Federal Reserve took action then after that happened, even though the economy was still expanding. These are the only exceptions I could find. I've looked through the Bloomberg terminal. It just doesn't happen. So this would be a huge change in interest rate policy by the Federal Reserve if they do cut rates 3 times while the economy is expanding like this. So this just doesn't happen. So let's see what happens. Anything can happen in the market. I could be wrong. If I am wrong, I'll be wrong. I mean, I'm not going into the meeting with any positions that put me at serious risk. So I'll just act on the big levels. I'll stick to the plan. And if the conditions change after the Federal Reserve meeting, I'll update my plan, no problem. So let's go to the charts, see what we have here. Now, by the way, this is the 3rd time I'm trying to record this video because we're having some severe weather here in the region. Tornadoes have knocked out power. The power has come back on. Hopefully it stays on. I just need 20 minutes to record this video. That's all we need. So let's see, 3rd time's the charm with recording this video. So I'm going to start with the S&P futures here. Now, this is the same chart. I haven't changed it. I've moved these targets over, but the levels are the same. We have a short-term impulse uptrend, and I call it an impulse uptrend because to me the market has 3 trends. Most of the time it has an impulse trend line, and this is usually taken from the 4-hour chart. In this case I'm taking it from the daily chart, from these lows here, and we can actually extend this out, and I think it forms a channel, but I'm not going to do that because, yeah, here you go. I'm not going to do that though. This is a short-term level. I don't trade short-term levels. I use these levels to manage open positions. So if I had a long position still, I had a long position up to around here and I closed it. But if I did have a long position and this trend line broke, I'd take most of it off. And that's what I use these short-term impulse trend lines for. I don't use them to open positions. So its price is still above this trend line. I think today that trend line will be at 28.82. 50-day moving average. The 50-day moving average is right here at, where is it? 28.76 and 3/4. Let's just say 28.77. That aligns with a demand level that was a big deal back here in early April. So, you know, it might get a short-term bounce out of there. I will not be trading that level. I think if this trend line breaks tomorrow or Tuesday, and that seems pretty likely, but who knows. If this trend line breaks tomorrow or Tuesday, you will probably get a short-term bounce here at 28.66 to backtest the breakdown. This tends to happen. RSI actually isn't sloping down, so that's very likely to happen in my view. I'm not sure if I'm going to be taking that trade, buying it for a bounce. Maybe. We'll see. I don't have any orders there right now. My orders are here. And this is this to me is a major zone. And this is what I call a convergence zone. Okay. Here, if we zoom out, we have this trend line here, and this is that divergent double top that we had back in September and October that gave us the major market top in the S&P and the stock market in general, in the U.S. stock market. That extended down to here. You'll remember from March, this was a big level. I never took it off the chart, so it's still here. That was an easy level to trade. You'll remember we traded that very successfully here. And then it broke out. We didn't trade it so successfully here, but it broke out, and that's still in effect. Okay, it acted as a pivot point. Its price gyrated in equal measures above and below this in mid-May. So that becomes a pivot point. I think it might come back into play if it does try to make a higher low. So that trend line will be a key level to watch, and that's where my order is. Now we also have the rising 18-day moving average. Okay, so that forms a zone that converges with this, and then we have this very likely channel here. Okay, it doesn't. This is actually a weekly trend line, so it doesn't show up too well on the daily chart. But this one's a big deal. It goes back several years. I showed it in a prior report. This one here is just this trend line, and I took a parallel line, I made it, and I formed it here at these major lows. Okay, and here. My models confirmed that as a valid trend line because of mostly because of volume spikes and order flow here. So institutional volume came in here. Institutional trading desks are watching this level. And so this is what I call a convergence zone. And we have an apex here, a crossover. So I will be buying here. Now you're probably wondering, why do I pay so much attention to convergence zones? Why do I call them convergences? Well, when you get a convergence zone, which is different types of levels coming together, it's not different levels coming together, it's different types of levels. In the market you have traders and investors that trade around moving averages. That's one set of traders, and they have their own accounts, they have a lot of money in their accounts, and they're waiting for those moving averages. Now those traders are different from the ones who will be trading this trend line. This is a totally different set of traders. They're waiting for this, and they have their own accounts in cash waiting for this. You also have people trading this trend line. You also have moving averages on the weekly chart right here. And not only that, you have Fibonacci retracements there. You'll notice, see this, okay, this zone here is the 50% and 38.2%. It's so Fibonacci traders will be watching that zone too. Now, by trading around these convergence zones with different types of levels, we are enlisting different types of traders with different strategies onto our side. They become our allies. It's not just one set of traders that are waiting for a bunch of levels. These are three sets of traders: Fibonacci traders, major trendline traders, and moving average traders. So that means there's a lot of liquidity waiting for a pullback to this zone, okay, from three categories of traders. So to me that's a high probability trade. I'm willing to take it, and I have 8 contracts ordered to buy to open right here at 28.34. Okay, sometimes I scale in across the zone. I might enter 2 here, 3 here, and another 2 here, or 3 here. But I'm just keeping all the orders right here at 28.34. Okay. Once we get a bounce from here, you'll also start seeing pattern traders giving this follow through, possibly sending it back all the way to this neckline. So that would be a nice move if it happens. If I'm right, who knows? Could be wrong. But if it happens, that's 81 points. Okay, that's a decent move. I'll take it. So that is my plan. I'm going to ignore this area here. I'm not going to buy here. I'm going to wait for this zone. I want maximum probabilities, maximum upside, and as little risk as possible. Now, this is something I don't usually show in the reports, but let me just go over it. People who have followed me on Twitter or StockTwits for a while will remember that I tend to separate support and resistance levels into tiers. It's Tier 1, Tier 2, and Tier 3. Now each of them has unique characteristics, but based on market conditions, I set my buy orders at Tier 1 or Tier 2, or sometimes if things are really bad, I won't buy at all and I'll reserve my bids for Tier 3. We're not there right now. Okay, you'll remember that in May last month, I was waiting for Tier 2. This is where it was. It was over here, 2780 to 2795. Okay, so based on market conditions, I select my buy zones based on where the tiers are set, and I have a model that sets the different levels and zones that I trade at. But this isn't something I usually show in my reports because I don't want to make things too complicated. But when I make my decisions on big swing trades, I always wait for those tier zones. That is a huge factor in my trading. And learning how to be patient and waiting for those zones and nothing else took years. I mean, it takes years to develop just the mindset and patience to wait for price to come to you. But believe me, it is so worth it. It pays off in a huge way. I mean, my trading turned around after that point. You know, triple-digit profits percentage-wise every year ever since I switched to trading tiers. And I set those tier levels each Sunday night. Once a week, I adjust them based on conditions. So that's just a little something extra. I don't usually feature it. I might in the future. But that's what I'm waiting for, this. Now, what could happen? What if I'm wrong? What if price doesn't pull back here? What if it breaks out of this trend line? Where could it go? Well, this isn't a completed inverse head and shoulders pattern. So I wouldn't use this as a measured move to measure how far it goes. Instead, I'd look at this high over here. Okay, there's a zone, 29.46. To this high here, actually, I'm going to take the top of this candle body. So if it does break out, and the breakout confirms, the first target would be here, this 29.46 to 29.55 zone. 29.46 was the high here at this market top. That's a big level. Okay. And we can actually see right here, the top of these candles bodies was right at 29.46, that high from September. So that's an important level. I think that's where it would extend if it breaks out. If it really extends, there's actually an easy way to do this. Wrong way. Okay, let's try that again. Okay, so let's go back to our Fibonacci chart. If the market runs wild, and for whatever reason, suddenly there's a resolution to the trade war, for instance. Suddenly, if the trade war gets resolved, the best case scenario would be a move to this extension here. That is a huge move. But if that happens, if suddenly the market gets a huge catalyst to the upside that creates a breakout from these two zones, this would be the next target. It's hard to believe, but that would be it. These Fibonacci extensions tend to be pretty accurate. The Fibonacci extensions gave us this high, for instance. So, pretty interesting. I don't think that'll happen, but it's always good to be aware of these things in case they do. Because trading is not about predicting the future, it's about anticipating the different outcomes and being prepared with a plan for each one. That is a key mindset. So that's my plan for the S&P futures. I'm keeping it simple. Buy here for a move up to here. Okay? I'm buying here. Actually, I'm buying. This is going to move down my entry each day as this trend line moves down, by the way. Right now, today, if the market collapses for whatever reason, that would be my buy. If it filled today, my target would be probably take a week to get up there. So 81 points above. I would take profit on half the position at the 50-day moving average, the rest up here. And that would be the end of that trade. I would take my 81 points and call it a day. All right. So that's it. There's no RSI pattern right now. We can't get anything. This breakout is still in effect, but momentum is flattening out. We often see higher-low pullbacks. I call them higher-low pullbacks because they pull back and then return to rally mode after making a major higher low. So these are the higher lows that I anticipate. All right, let's move on to oil. And this is actually a bit interesting. It broke out of this falling wedge, which is nice, but that's not what I wanted to show you. I wanted to show you the weekly chart. Now, crude oil futures have rolled over to the August contract, but not on TradingView. They haven't rolled it over yet. This is still the July contract. This will, I guarantee you, this will roll over to July by Tuesday. So, and the July contract, which is now the active contract on pretty much every trading platform, is 30 cents above. So it's above the 200-week moving average. To me, that's important. And I'm still holding my crude oil August contract, which actually expires in July, and those have about 4 weeks left to expiration. 53, 56 debit call spreads. Now you'll recall I entered those right around here. Yeah, I posted that on StockTwits in the forum and the reports. I entered them 25% size at 53.10, and I entered another 25% size right there near the 200-week moving average at 52.50. Right now the position has a 1% drawdown, so it's recovered very nicely from down here, but it is not showing a profit yet. It was showing a 20% profit up here. I should have taken some off, but you know, that's the life of a swing trader. Sometimes that happens. I'm still confident it'll go up here. So my first target is right here, 56.71. I'll take half the position off there, and that's right here between these two Fibonacci levels. And the reason I'm taking half off there is because, well, first of all, these are 53, 56 debit call spreads, so there isn't much profit potential above 56. I mean, it will already be near the maximum profit once I get there. So it makes sense to take some off. That is the midpoint between these two Fibonacci levels. Now, we never know if this is a real major bottom, and this goes all the way up to the upper flag level, which would be amazing. I would short it like you wouldn't believe if it gets up there. But we don't know if that's a major bottom. RSI support is held. We have a bullish RSI divergence on the shorter term charts, which is always nice to have, especially in oil. Crude oil loves those RSI divergences. So, but we still don't know if this is a major bottom or if this is just a dead cat bounce and this thing's about to collapse. We just don't know. We never know. We never know the future. So we have to manage risk. So if this is a dead cat bounce, okay, the target would probably be around between here, between these two Fibonacci levels, and all the way up here. Dead cat bounces most often go to just under the 50% retracement of the entire move, and sometimes they extend all the way up to the 61.8%. And we actually see that very often in the NASDAQ futures. That's a very common dead cat bounce retracement target. I remember back in June of 2017, I've made huge piles of money just trading these Fibonacci charts in the NASDAQ futures when they collapsed in June 9th, 2017 with the Goldman Sachs warning. Yeah, that was a nice buying opportunity. But here, I'll be taking half off here. The second target here, which I actually need to update, is the 18-week moving average. Last week, it was at 58.95. So the target was to get out on the remaining position just below that moving average. Okay, this moving average is now sloping down. That's not good. So I want to reduce this target. Okay, it's at 58.78. I'm getting out at 58.50. So I'll get out half the position here, 56.71, and the rest of it at 58.50, and then I won't have a long position. We do not want to carry long positions into this zone, let me tell you. That is not a good idea, in my view. If price extends beyond this retracement level, then we probably have a bigger move in store, and it could go all the way up. See this? See these two moving averages? That's the 100-week. This is the 50-week. 50-week is declining. Okay, that shows that crude oil is in a, you know, it's in a year-long downtrend. Going back 50 weeks, which is about a year, the 50-week moving average is sloping down. This is still in a downtrend. This moving average to me is a sell. And you'll remember that this moving average played a key role back here. So if crude oil bounces all the way back up here, and next week you might actually get a crossover, the 50-week crossing below the 100-week, I will start a short position here. Probably 20% size, and then another 30% up here at this flag level crossover here. This is a monthly resistance level here. So if that happens in 2 weeks from now, and crude oil gets all the way up here, that's a good short selling trade. And I would have to stop on any close of the week above this flag level. So this looks good. That would coincide with the RSI resistance here. If it gets up to this zone, we might see a rejection here. A breakout of both of these, price flag level, RSI flag level, would be a huge deal. And let's look at the monthly chart. Okay, if that happens, and I don't think it will, but it might, you never know. This would be our target right here, 71.50. If this price and this RSI flag level breaks out to the upside, again, I don't think it'll happen, but I can't tell the future. But if it does, this is the target. That short trade would become a breakout trade to me, and I would go flip to long for an almost, I mean, would be a very high probability move up to here if that breakout happens. Especially if the US dollar continues to break down and gold continues to rally. This would be a huge breakout trade. So let's keep an eye on that. Right now I'm bearish crude oil, and my bias is to take profit on this spread, short this zone, and you know, we can set targets once we enter the short, but that's my plan. Long up to here, short up here. Easy, easy, easy. Okay, so we were just mentioning gold. As you can see, this flag level has been incredible. This on the daily chart, it just refuses to close. Gold refuses to close above this flag level. This would have been huge if it closed above it. I mean, this would have been the highest close in about a year and what is it since. All right, that would have been, if it closed at the high of the day on Friday, that would have been the highest close since January 2018. That would have been a big deal. But it didn't happen because flag levels are very difficult to break. You know, it's not a breakout until it closes on the other side of it, so you might see a rejection here, who knows. With the Fed meeting, anything can happen. Now, here's my plan for gold. Gold is in an RSI uptrend. The 18-day moving average is rising. You have this over here, the 100-day. This is a daily chart, by the way, and 50-day. Flag support on the daily chart is here. And this is going to move here. This is no longer relevant. I'm taking this one off. Oh, I should have bought this breakout. Too bad. Yeah, this is my favorite buy level if it happens. If the gold price moves down there, it would break its RSI uptrend. That wouldn't be ideal, but for now, unless the Fed suddenly comes out much more hawkish than even I would expect, this would be a buy level for me. And the reason is the weekly chart has the reason. And we'll look at that tomorrow. I don't want the power to go out again and cut this video short, but this would be my buy level. Now, if you're aggressive gold on the long side, you might consider buying here. That's high risk. Or here, or even the 18-day moving average. This 18-day moving average is, I mean, the slope of this moving average is almost vertical. So we'll definitely see a reaction there if price moves there, but I think it might be short term. I don't think gold is ready to break out yet, and let's move to the monthly chart for the reasons why. Okay, the monthly chart shows. Okay, let's delete all this. It's not relevant anymore. This is the biggest level by far. Definitely buying if we get that. Okay, Fibonacci. This remains intact. This is pretty impressive. On the monthly chart, look at where it reversed. Okay, if you look at past reports, you'll notice that this monthly resistance level has been there at least a year and a half on my charts. And you can see how prices reacted to it each time. You have big upper wicks, and that indicates supply. That indicates there are sellers here. And there are a lot of them. And this goes back a ways. This goes back 2014. Big level. And that's pretty much where we found the high of the day on Friday. Right there. Actually, exactly. Oh, that's pretty good. I should have shorted it, but I don't trade around Federal Reserve meetings. So this is that flag level from the daily chart. As you can see, on the monthly chart, gold is in a symmetrical triangle pattern. Now, is gold going to break out? I think so, probably, but I don't think it's ready to do it yet. And the reason is there's still so much room, so much time left until you reach the apex of this triangle. These patterns are pretty reliable. They're very reliable, actually, but the probability of a breakout or breakdown increases the closer price gets to the apex. The apex for this pattern is on May of 2021. That's almost 2 years from now. Now, the closer you get to this apex, that's the apex, the higher the probability of a breakout occurring goes. So a year from now, you'll get a very high probability of a breakout. Right now, price is still very far away from this apex. So the probability of a breakout tends to be pretty low, but it can still happen. I wouldn't count on it, though. And another reason is if you go to CNBC, Bloomberg, Wall Street Journal, you'll see right there on the front page, actually, as of this afternoon, headlines showing that, they're basically confident that gold is going to break out. Yeah, Paul Tudor Jones talking about a gold breakout. You have the Trading Nation people, the commodity people on CNBC. I don't watch these shows, but I use Sentiment Trader. That's a service. It tells me about all these headlines to tell me what the market sentiment in the media is. And universally in the media, Wall Street Journal, CNBC, Fox Business, Wall Street Journal, Bloomberg, I mentioned them. It's all positive. They are all so confident that this pattern is going to break out to the upside and soon. That tells me that a lot of the people, a lot of the bulls counting on this breakout have already bought. I mean, all the buyers who are aggressively trading a potential breakout, they're already in. So you saw what happened there on Friday. When price moved up here, you didn't get much follow-up buying because the sentiment is very crowded on the bullish side right now. Pretty much everyone who's an aggressive trader who's trading this breakout has already bought. So when price breaks out, there isn't many people left to buy. Now there's another category of traders out there who are bullish gold, and they're the ones who wait, or like me basically, they wait until price closes on the other side of this trend line. But they wait for several weeks before they buy in. So if gold breaks above here, chops sideways, and stays above this level for say 3 weeks, well, to me that would mean that this becomes support and the breakout will probably happen. At that point, those really patient traders who wait for confirmation, they will start buying and accumulating. So that's what I think. I don't think this is ready to break out. I could be wrong, but I think we're seeing price action evidence of that. There's no follow-on buying. Sentiment is too bullish, so I think a pullback, maybe even here, to flush out the bullish sentiment. From there, it has a good springboard to break out. I would be more confident if the breakout occurred, of a breakout occurring, say, a year from now. At that point, the probabilities, the odds really favor the breakout. The risk-reward is better because there'd be more upside to the breakout because the trend line would be here. The closer to the apex you get, the better the probability. So that's my view. I'm going to wait until here to buy. And it's as simple as that. Fed meeting, by the way. Fed meeting happening June 19th. This is when the Fed meets. Okay, never carry gold positions into Fed meeting. That's my personal rule. So after the Fed meeting, I'll get back to trading it. Until then, no thanks. By the way, pattern for gold going into the Fed, with the exception of December 2017, and who can forget this one? Holy cow. This was amazing, this rally. With the exception of this one, after the Fed had rallied like crazy, gold has tended to be bearish after Fed meetings basically since 2015. That's probably the only exception. You got a super trend here after the Fed meeting in December 2017. Almost every other time, it's been neutral or bearish after the Fed meeting. Just a pattern. I don't make decisions based on that, but it's good to note what the market's tendencies are. So there's the Fed. Treasury bonds, big disappointment. Actually, let's look at TNX. Okay, TNX. This RSI chart is totally useless right now. We have to wait for that to come into play later. This morning star that I was looking for did not happen. Did not happen. That is a real disappointment, because that would have set up a huge move, huge high probability move up to here, which we could have traded through TLT, the ZN Treasury Note futures. This would have been easy, but we didn't get that pattern, so that setup is gone. Okay, that setup is gone. I thought I'd put this level in here, but I didn't. Okay. Yeah. This is a demand level here, but it's not a very strong one. Okay, so for TNX, this is going to be the most closely watched chart next week, by far. No other chart will be watched more closely than this one. So let's see what happens. We want this level to hold. Okay. Boom. Flag. Okay. If we believe that this is the bottom in interest rates and Treasury bonds are about to correct, and that the 10-year yield is going to move up here this week, this level has to hold. That's 2061. No, it's 2060. This is a big level in 2016 also, just before Trump got elected. Big deal, this level. So this has to hold. So if this breaks down, that's a problem for the stock market too, because that would signal that forward returns on capital are being discounted heavily. This would not be a good thing for the stock market if this broke down. People think low interest rates good, but in this case it wouldn't be. It would be good for real estate if that broke down. I'm still looking for a move up here, possibly this week. If this breaks out of this major cycle trend line, that's a cycle trend line here. Okay, goes back to November of last year. The first step is to fill this gap. Go up here. If it breaks out, let's have a look at the Fibonacci's. Okay. I don't know if this is the proper way to do it, but I'm going to do it anyway. From this high here in October to this low here. Okay, this mid zone here. See, this is that zone coming into play again between the 50% Fibonacci retracement and the 38.2%. Right here in the middle, it coincides with a supply and demand level. This is probably the target if TNX breaks out of this flag downtrend. Right here, why not right here too? Actually, I'm going to move this. This is my target. if TNX breaks out, this is my target. Right here. Let's say mid-July. Okay, Treasury bond futures would become a buy here. Remember, interest rates and Treasury bond futures move inversely of each other. Okay, when TNX is dropping, Treasury bonds go up. When TNX goes up, the value of existing Treasury bonds goes down, because new Treasury bonds are yielding more interest than the old ones. So that means the old ones, which is what this is charting Treasury bonds going back 30 years, become worth less because they're paying less relative to the price movement in TNX. So if TNX gets a flag level breakout, this week would be amazing. That would be an incredible candle. It wouldn't be a 3-line strike, but it would still be amazing if we do get that breakout, and it is possible. ZB would probably pull back here initially. This zone right here would become the buy zone in ZB. Right now I have a buy order here, but longer term you'd see here, this is a bigger one. So this would be what I would call tier 1, tier 2, tier 3. So the big order would always be at tier 3, which is the flag level on the weekly chart. This is where the big buy order is. This is what I've been waiting for since March. We almost got it, but not quite. So let's see. This is an important level. If for some reason Treasury bond futures collapse, you would almost certainly see a huge bounce. I mean a huge bounce from here to 152.09 right here. So this would probably bounce from here to here. So that's why I have a buy order here in case it happens. This is what I call a stink bid. A buy order far away from the market in case something crazy happens and takes it to a strong level. I get in, I can harvest a huge bounce and get back out. I get fills on these 4 or 5 times a year. That's easy money. Why not? They've always worked for me. I mean, there hasn't been a single instance where these have failed, but you don't get them very often. Okay, IWM. This is the weekly chart in IWM, but I wanted to show you this moving average convergence here. You have the 200 week. It's shadowing a weekly uptrend. I think that uptrend is from the monthly chart because this doesn't make any sense. Delete it for now. But this zone here is probably going to act as resistance. If it gets above it and closes above, we could see a turnaround in small caps. But this is probably worth watching. Now small caps didn't do very well on Friday. They saw some selling pressure while the rest of the market held firm. This chart's looking a little messy right now. So it's down to this demand level. This short-term uptrend is broken. Doesn't look like this channel is working, but I'm going to get rid of it. This is the important level because it's right above this moving average cluster. Sellers did come in here. IWM underperformed. I wouldn't make much of it yet. This is noisy price action right now. I'm not trading IWM. I already took profit on those naked puts I sold on the small cap futures, so I have no position here, no open orders. I wish I had my volume study open, but I'm just going to have to guess on this trend line. This is not a key reversal candle, so it can easily recover. There's no signal in IWM right now, so I'm staying out. So let's see here. I wanted to show you the Euro chart before we go. Euro reached my buy level. at the bottom of the chart. You'll remember I set the buy level at 1.1215. Now this buy level got filled. This buy order got filled on Friday when Euro just collapsed down to it, and it stopped dropping right there. So I have a small long position here, which I'm already regretting because the Federal Reserve meeting is on Wednesday. So I will be getting out of this long position on a bounce to 1.124 because I don't want a position here going into the Fed. That is not something I want. Bad idea. So buyer's remorse coming in. I'm going to get out on any bounce. I can always get back in after the Fed. So let's take a look at the New York Stock Exchange composite before we go. Okay. This is kind of interesting. Okay, NYA tried, and this is the biggest index in the U.S. markets. It includes pretty much everything that's actively traded on the New York Stock Exchange. Oh, look at this. I'll take a look at this later, but this looks interesting. Okay, so this tried to break out last week. It got rejected pretty hard, especially on Friday. Now the S&P and the NASDAQ, especially the S&P and the Dow, held firm on Friday, but not IWM and not the broader New York Stock Exchange composite. That closed under the upper flag level. And this isn't a shooting star candle because it has a wick down here. Shooting star candles typically have no wick at the bottom. So this isn't technically a reversal candle. This is just not a very good candle on the weekly. It closed under the flag level after breaking out. Let's see what happens here. If it breaks under the 18-week moving average on a closing basis, we could have a failed breakout, and that would be bearish, but we need much more price data before we come to any conclusions. Right now the market looks neutral to me. I'm not bullish or bearish. Okay. Well, I mean, I'm still amazed by this candle. It came very close to forming a three-line strike, but these are very rare in the S&P futures weekly charts, so that would have been interesting. That would have gotten people talking. Last week we closed with a doji star. This is a spinning top doji star candlestick on the weekly chart last week. That's a neutral candlestick. Okay? We didn't get a gap down, so it's neutral. If we would have gotten a gap down, that could potentially have become an evening star pattern, but we didn't. So this is not a reversal candlestick. This is a neutral candlestick. So it looks to me like price may bounce between support and resistance for a while. Okay. So that's pretty much it. Let's see what happens with the Fed. Several possible outcomes here. Market sentiment is neutral in the S&P and the NASDAQ. It's not too bullish, it's not too bearish. Market sentiment in gold is very bullish, which is usually not a good thing for price. This could become a failed breakout in gold. Anytime positioning is too bullish, I'm very skeptical of breakouts, so keep an eye on that. The Fed seems like a perfect catalyst for a move in gold this week. So that's it. If you have any questions, just post on the forum. I will be posting this video on the forum. Until then, be well, trade safe, and have a great evening. This is Dante.